Sometimes a single business deal can be a massive signal, a real bellwether for a huge shift in an entire industry. It's not just about the money changing hands, it's about the strategy behind it. In a recent acquisition in Kenya's fintech space, well, it's telling us a whole lot about the future of finance across Africa. Let's get into it. So here's the headline. Moniepoint, a fintech titan from Nigeria, has officially bought its way into Kenya. Now, this isn't just some simple expansion. Nope. This is a strategic chess move into one of the most competitive markets on the entire continent. And it really gives us a peek into the next phase of African tech. Okay, so to really understand the gravity of this deal, you gotta know who's involved. On one side, you have a Nigerian powerhouse that's looking to build a pan-African empire. And on the other, a Kenyan pioneer who just found a very, very powerful new partner. So in one corner, you've got Moniepoint. Calling them a giant in Nigeria is frankly an understatement. They process an absolutely massive amount of the country's point-of-sale transactions. But, and this is key, they were a total newcomer in Kenya. No footprint at all. And in the other corner is Kopo Kopo, a Kenyan company that's been in the game since 2011. They're an established local player, and they are laser-focused on one thing, helping small and medium-sized businesses with digital payments and credit. Okay, let's zoom in a bit. Let's go from the corporate boardroom right down to the street level. Because to really get why this deal is such a big deal, you have to understand the problem Kopo Kopo was built to solve. And that is the constant grinding challenge that small businesses face just to get financing. I mean, this quote right here just captures the absolute terror that every small business owner feels. The world of financing is incredibly high stakes, and one bad move, one bad partner can sink you. Finding a trustworthy source of cash isn't just a nice-to-have, it's a lifeline. And this is the exact problem that Kopo Kopo's main product is designed to fix. Kopo Kopo's secret sauce is something called a business cash advance, and it is a seriously clever model. See, instead of a traditional loan where you have these rigid fixed payments every month, Kopo Kopo basically says, hey, we'll buy a tiny piece of your future digital sales. What does that mean? It means your repayments are tied directly to your income. If you have a great day, you pay back a little more. If it's a slow day, you pay back less. It's flexible. And this breaks down just how simple it is. Step 1, a merchant starts using Kopo Kopo's system to take digital payments from customers. Step 2, once they've built up a solid history of transactions, they become eligible for a cash advance. And then Step 3, a small pre-agreed percentage from every single digital sale they make automatically goes to pay back that advance. It's totally seamless. So, what's the cost? You're probably wondering. Well, for merchants who pay back on time, the interest rate is a fixed 5.9% per month. It's pretty clear, pretty straightforward, and it's the price for getting that quick access to capital. But, of course, you gotta have some rules, right? If a loan is overdue by 15 days, a 10% late fee gets tacked on to whatever amount is still left. So the whole structure really encourages you to repay on time while still giving you that flexibility in the beginning. And this is what it's all about. This is the real-world impact. For this business owner, moving to digital payments wasn't just about it being easier. It was about security. It was about peace of mind. I mean, that is a fundamental, game-changing shift in how you run your business every single day. All right, so a big foreign company buying a smaller local one, that can definitely raise some red flags with government regulators. So why on earth did the Kenyan government give this deal a quick and unconditional thumbs up? The decision really came down to this body right here, the Competition Authority of Kenya, or the CAK. And their job is pretty simple. Make sure that mergers don't end up hurting competition or, the general public. And you can bet they took a very, very close look at this deal. And this chart, honestly, this chart tells you everything you need to know. The digital lending market in Kenya is absolutely dominated by a few giants. M-Shwari, Fuliza, you see the names. And where's Kopo Kopo? Well, they're somewhere in that tiny 4% slice labeled Others. In the grand scheme of things, they are a very small fish in a very, very big pond. So the CAK's logic was actually pretty straightforward. They approved it for two big reasons. First, since Kopo Kopo is so small and Moniepoint is brand new to the market, this merger isn't going to hurt competition at all. In fact, by giving Kopo Kopo a lot more resources, it might actually heat things up and increase competition against those big guys. And second, there were no public interest issues. And a huge part of that was the fact that all 98 of Kopo Kopo's employees get to keep their jobs. That's a win-win. Okay, so for this last part, let's pull the camera all the way back. Let's take a look at the continent-wide picture. What does this one little acquisition in Kenya really tell us about the future of finance in Africa? The big takeaway is this. We are officially entering a new era. The African fintech scene is maturing. The most successful companies, the Moniepoints of the world, are now so big and dominant in their home countries that the next logical move for them is to expand. And often, the smartest way to do that is by buying up established local players in other countries. And this is exactly why this model is so powerful and so attractive for a company looking to expand. A fascinating study found that this type of credit completely changes how merchants behave. They start pushing their own customers to use digital payments so they can qualify for bigger advances. They pay back their loans way faster than they need to, not just to clear the debt, but to immediately get access to a new loan. And a lot of them just take the maximum amount offered every single time, basically treating it like a permanent line of credit. It's an incredibly sticky product. So, we end on this big question. Are we looking at the new playbook for fintech growth in Africa? The strategy seems to be build a massively successful model in a huge country like Nigeria, and then, instead of starting from scratch everywhere else, just buy your way into new markets by acquiring smaller, established companies, like Kopo Kopo. It's a strategy that could completely reshape the financial landscape for millions of small businesses all across the continent.